We will identify companies not by their company name, but by the number of employees, and we'll go through smaller companies, mid-sized companies, and large companies, and identify strategies and methods that have been incorporated and utilized, some relatively new and some that have been time-honored, that genuinely save money and improve employee benefit plans. The first company I'd have Alan address is a nonprofit with 19 employees that he used a couple of very basic strategies to save a great deal of money. Alan, would you like to talk about that?
Sure. In Connecticut, any of these groups that are 50 or less employees, what we define as the small group market, there's some flexibility, but differently than the larger groups where there's quite a bit of negotiation that's available. On a small group, there really is no negotiation per se. The rates are the rates. Obviously, you can do many different types of plan designs. Most carriers in Connecticut allow at least 3 or more. Some will do up to even 5 different plans, which is good because we do often get referred into some groups that have one plan. And I always question that, especially if there is a contribution from the employees, which is typical of most groups. I always will ask if there's a contribution, then obviously the employee has a little bit of the skin in the game, in which case I would strongly recommend you have at least what we call a high and a low option, preferably maybe even 3 options, like a low, medium, and a high option. Picking probably the low option is what we call the company sponsored plan, also known as base plan. By doing that, it will hopefully reduce the cost of whatever plan they've got in place. In this particular group, they actually were, they did have 3 plans, but the 3 plans were all gold options, which didn't make any sense because they were very close as far as the benefit. There was $1,000, a $1,500, and a $2,000 deductible plan with various copays, but they were all very close, not only in benefit, but in cost. So I felt that I'm sure I can possibly reduce your costs and make this a little bit more attractive to the whole group as a whole. So when we ask always, which we do, is for a census, which is just a listing of the employees and their dependents, if they're covering them with all of their ages. In Connecticut, in the market, small group market, they've done this since 2014 when the ACA created the new form of insurance that we've now since been in for 8 years now, where everything is age banded, meaning every single person within a family gets their own rate based on their own age. So you've got a husband and a wife and 2 kids. They each have their own age. They each get their own rate. You add it all up, and that's your total rate for that family. I can't tell you how many groups are not even aware of that, but it's been that way for 8 years. So that's kind of how we start the process. We want to see what they have, what the summaries of the plans are, how old or young or medium the group is, and basically from there, try to determine if they do live in different parts of either the state and sometimes in other states. We always want to make sure that the network is a good fit. I have to say most of the networks now are, I'll say, reasonably more comparable than they used to be. They all have pretty big presences. Almost all of them offer national networks. So you're not just stuck with a Connecticut only network because people do travel and they have to go to meetings and they're out of state. You can't have somebody without coverage when they're somewhere else. So by doing that, the first thing we notice when we get their census is how old everybody is. In this particular case, what made this a little easier, what really jumped out at us, is of the 19 people, 5 of them were 65 or older. So they were Medicare eligible. Yes, they were still working, they were full-time, and they were on their company plan. But the plan they had been in, and this was going to be the 3rd year they were going to renew with them, got absolutely hammered at renewal the first year. And then this year we're actually abused. And I use that word reluctantly, but they got close to 100% increase over 2 years, which to me is obnoxious. And because of that, this is a nonprofit, as Gary said. They don't have the money to be able to absorb that kind of increase But a lot of that was based on some of the folks they had that were, on the older side. So I had just suggested, because you can't make anyone come off a plan and go on to Medicare. However, if it's a win-win and it makes more sense for not only the employee, but also for the employer to have those folks go to a Medicare option that might be significantly better plan-wise and ridiculously less costly than what their group plan is, by just moving those 5 people, in essence, save this group over $10,000 a month. It was humongous. And that's how high the rates were. I mean, the increase for this year jacked up the rates to over $1,700 a month for an individual. And yes, they were fairly good plans, but those rates were just unsustainable. They couldn't afford that. So by moving 5 of the people, who you have to be careful, and we always are, to explain to them if this is something that's going to be better, because it was, the plans are much better, and it's going to end up costing the employees significantly less money and saving this nonprofit thousands of dollars, it made a ton of sense. So they were certainly into doing that, which we've already done. And then the rest of the group, we quoted with a plan, but instead of doing 3 gold plans, we offered a silver, a gold, and a platinum. Platinum being the best plan, lowest deductibles, in this case, 0 deductible. Yes, it's got the highest cost, but that should be only for the people who really need that kind of plan. Even the gold plans, which were slightly less than what they had, but again, making that a buy-up option for them. But the silver plan, which was still a very good plan that gave them co-pays for many services, doctors, labs, x-rays, prescriptions, urgent care, walk-in, all plans cover preventative care for free. So in this particular case, that became their base plan, which was already going to then save them another almost $6,500 a month. And then if anybody, because of their personal needs, health-wise, wanted to buy up to either the gold or even the platinum plan, they could do that, and they would just pay the differential. And they thought that was brilliant. Never heard of that. And I think that that's a strategy we've used for several years. But it just makes sense, because it will keep the liabilities on the employers to a much lower level, which will keep them from spending way too much. But it also allows anybody who really needs to get the best plan available based on their personal medical needs, the option to buy up to a plan like that if that's what they want. Every year you get open enrollment, you can always change. They could always go back to a lesser plan if in fact it's like a pregnancy where they know they're going to spend several $1,000s. They might want to just get something that is better for that year, but then when the baby is born and there's no more pregnancy, at least for the following year, they can go back to a lesser costing plan. So by doing that simple strategy, it ends up where this company is going to save close to $200,000, which for them as a nonprofit was life-changing. I mean, they're extremely happy. The employees are happy. Interestingly, the 5 people that we met with individually that went on to Medicare, they're extremely happy because their plan is significantly better than what they had and what we were even offering. And the rate, in essence, was next to nothing. So they were saving a lot of money for their contribution. The company saved a lot of money because of the overall cost being so much less. And it ended up where it was a win-win. So everybody benefited from this. So that, for a small group, made a lot of sense. It's not a strategy that I'm going to get into in a couple of these other groups that Gary brings up that would have made sense, that being what we call level funded plans. I'll get into that. Mm-hmm. But the group has to be reasonably healthy, and we were aware of at least 3 of them who brought that to our attention that were not in very good health. And because of that, it wouldn't have been an opportunity that they would have been able to get anyway. So in this particular case, we ask questions, we find out what they have. In this case, really the biggest detriment was cost. I mean, their premium was just astronomically too high. So we just tried to find different ways to reduce that, but yet still keep their coverage at least close to equivalent to what they had, and in some cases even better. So that's what we did for that.
Yeah, so those strategies are time honored. It's sort of low hanging fruit. Anyone that can looks at these census can really start to pick this up, and that works for all company sizes, whether you're 20 or 2,000. Now, another small company with 21 employees, but Alan incorporated a completely different strategy. He just alluded to these level funded plans. But first, I want to have Alan just explain a little bit about the genesis of level funded plans and how they work and why they're so well received.
So this is a type of a delivery from all carriers now. Every one of them offers them. 4.5 years ago, one major carrier, who everybody has known, it's a household name, came out with the first of what we call level funded plans. They each have their own pet name for what they are, but that's what they are. They're level funded plans, as opposed to what pretty much every group has had for many, many, many years, those being what we call fully insured plans. Some differences, some major ones. In a level funded plan, the plan is underwritten, meaning they don't automatically accept a group with the rate that is quoted until they see what type of health the people are in. So, like I said, with the group that was 19, the nonprofit, where we were aware of 3 known conditions, we didn't even know about everybody else, but just those 3, 2 of which were major conditions, still ongoing. We knew level funded was not going to work for them because the carrier would not have accepted them. So it is a strategy that works for companies that say they're reasonably healthy, and there are many that are like that. So in this second group that Gary is referring to, it was a for-profit group, in fact, does very, very well. Been a client of ours for many, many years, had moved them between 3 different carriers based on rates when we just tried to find the best rate that was similar in point of time. But then what happened is we went to the first of now all the carriers that do these level funded plans because they were very healthy. And by going to that, not only did it reduce their premium by almost 21% in the first year, the other kicker that makes level funded plans so good and attractive to companies is at the end of the year, they have what's called a claims cap. So differently than a fully insured plan where you pay your premium in full, at the end of the year, your plan gets its renewal, it goes up, and that's the end, and you move on. But whether you had a really good year and you had very few claims, or you had an awful year and the claims were through the roof, you still get whatever the block of business and that small group size got. That's your increase, and you go on. In a level funded plan, they look at you more on an individual basis, meaning your company, not the whole block. So what happens is if you're a group that's reasonably healthy, just to put a number on it, say the total premium for the year is $100,000. If you're able to get that down by $20,000, that's one nice thing. But if your claims then are pretty good and you come in below what they expected you to come in, what they call that claim cap, they then allow you to share in what we call the surplus, the money that they did not spend. So if it came in 20,000 below the cap, there actually is one company that will give you 100% of the surplus. Most of them do 50-50. So they basically say, if you come in under the cap, not only did you get a good increase, because obviously it was a very well-run group, but you also then get a refund 3 months after the plan renews that gets applied toward in a form of a credit toward a premium, because it's money basically rewarding you because your group stayed healthy just like they were when you went in. Now, depending on the size of your group, there are carriers that will do level funded plans with as few as 5 people. Some will do 10 or more, some do 20 or more, and one needs 25. Now, the way it's underwritten, if it's less than 25 people, other than the one interestingly smallest one, the 5, they use a tool called GRX. And all it is really, it's a way for them to determine how the drug usage is, meaning all the prescriptions, they see what everybody takes, they know what conditions they're for, and based on the utilization of the drugs, they will determine on that if the group is a good risk or not. And we've had plenty of groups that actually get accepted, you know, where they may take a decent amount of drugs, but depending on what they are and what the conditions are for, companies still fairly enamored with them. So they'll come in with a very aggressive rate. And like I said, if they end up doing well, they also get a refund at the end of the year. This particular group has been in a level funded plan now. This will be the third year. They're renewing in December. They've gotten refunds every single year. Their rate with this year, we just got the renewal actually last week, is still less than what it was 3 years ago when we first moved them to a level funded plan. That's how much cheaper it is. Again, with the opportunity, if they continue to stay reasonably healthy, they get rewarded by getting a refund at the end of the year, which makes it very attractive. The only part of that where if you're set up to receive a refund, if for whatever reason, which is rare, you want to go to a different carrier, if you don't stay and renew with that carrier, you don't get the refund. So you do have to stay with the carrier you're with. In most cases, everybody does that because they're getting money back for doing nothing. So other than that, the one nice feature, major feature of a level funded plan, different than a self-insured plan, which is typically more pronounced in groups that are significantly larger. In most cases, I won't touch a group unless it's at least 100 or more, typically 500 or more, to do self-funded because it's a little risky. If you have one or two people that have major claims and something goes wrong, there's a thing that we call run-out claim, which means at the end of your plan year, if you go from January through the end of December, you may have a person or two that has a claim, hospitalization. In the last month of the year, those claims don't get paid in less than a month. Sometimes they take 2-3 months. So that run-out claim, if you're in a self-funded plan, you're still on the hook for paying those claims even after your year is over and you're now in a new year with possibly even a new carrier. In a level funded plan, you do not have that liability, which is a huge difference. So if you have a good year, everything goes well, you reduce your costs, you also get a refund, which just makes it a win-win. If you have a horrible year, I'll show you both ends of that. You still get an increase, but it may or may not be that awful depending on how bad the claims were. But at the end of that year, your plan, just like a fully insured plan, ends. You do not have any run-out claim at all. So your liability ends when your plan year is over. So you can go to a different carrier, you could stay with that carrier. So depending on what the increase was, and you may or may not even want to stay in a level funded plan, most do because the costs are better. But the nice thing is you're never penalized, especially in a small group market, because those are always guaranteed acceptance other than level funded plans. So if you had a horrible year and the increase was pretty high, we could always go back to another fully insured carrier and they have to accept you. So it's not like you have no more options. So it's just a very good strategy that works. And now it's becoming extremely popular. It started out as only one carrier. The second year, there were 3. Now the entire marketplace, they all offer these level funded plans. Just makes a lot more sense.
Well, there's a reason, because the first carrier that did it was so successful. And then the second carrier the next year. And what happened was all the other carriers were watching their healthy groups migrate over to these companies that were offering these level funded plans. And they were left with adverse risk.
Right.
That wasn't really a good business strategy. So they all jumped on it because it's a very successful model. Now, to get the GRX is so simple. It's a census. We need a full name, the zip code that they live in, and their date of birth. That's it. There's no health statements. There's no doctor notes, nothing like that. It's very, very easy to do. And companies say, yeah, just let me know. And we just get a very basic census, and we can say, you've been approved, this carrier will approve you, and then they start looking at specific plans.
Just one correction there. You could have to fill out health statements depending on the size of your group. Right. If you're 25 or more, every carrier does the GRX and there is no health statement required.
Yeah.
On certain carriers, if you're 10, 15 people and you want to go level funded, some do require that you actually fill out health questionnaires so they could actually see everything on you. They just want to make sure, kind of like life insurance, but not really, but they need to know a better picture of what they're buying into. because they are going to come in at a very aggressive rate. They just want to make sure they're not killing themselves.
Yeah, but that one carrier is very aggressive in Connecticut with only 5 employees on the plan, and just the names without health statements. And we find that it's a very prominent company, probably the most prominent. Now, I just want, Alan, if you could just give us a sense of how many companies that apply get approved, and those that are approved, what percentage of those companies actually get refunds, roughly?
So because we ask a lot of questions when we go in, typically if they're clients of ours or if we've been introduced for the first time, we will be very bold and ask them, how is your group as far as health? Is everybody reasonably healthy? Do you have any ongoing major conditions that people are being treated for? And they may not know the answer. They may not want to tell us, and that's perfectly fine. But if they say to us, no, everybody's healthy. We have a very healthy group. We don't know about their spouses and or their kids, but as far as we know, I think we're pretty healthy. So what we try and do is we'll do that first so that the ones that do apply for level funded, before they'll actually fill out paperwork, we'll know if they are going to be accepted or if they're not going to be accepted. And if they are, we know exactly what the rates then are going to be, so we could show the many different designs. I would say 80% of the groups get approved and close to 90% of the groups get refunds. That's why this market has worked so well, which is also why all the other carriers have now jumped into this, because they realize it does work. And not every company, as I said earlier, is a perfect candidate for this. We know right up front, they might say to us, well, this person had cancer 2 years ago, still going through all sorts of stuff. So, we might just tell them based on condition, it may not even be worth wasting your time. And I'd rather be honest and not make people waste their time. But at the same time, if they potentially could save a lot of money and get plans that are equal or better than what they had for a lot less, that's our goal. And in most cases, they are getting refunds.
Mm-hmm. We could go on and on with one case after the next of these level funded plans. But what I'd like to do now is move into the mid-market, which is 51 and over. There's one company here with 57 employees that we met a couple of years ago. And I was connected with, I met one of the major big managers, and they were lamenting about expenses and all that. So I said, well, let's take a look at it. And we did. Now, Alan, if you want to talk about what happened with this company.
Okay. So in this particular case, level funded really was not even an option. They were very specific, very much upfront, right off the bat. One of their employees had a child, I believe was like 10 years old, had a very, very bad disease, and unfortunately was hospitalized almost an entire year, on and off, in and outpatient. But in their mind said he probably racked up over $1 million in claims. Clearly not what a carrier is going to want for a level funded candidate. So that was off the table right away. However, that happened 2 years prior to when we met them. So I asked, and actually we met this gentleman. He was the one who actually took us to a tour around this whole facility. And he talked about his son quite a bit. But needless to say, she's still doing some treatment, but nowhere near to the extent that she was when she first was diagnosed with it. So the carrier they had gave them, I want to say it was a 54% increase after that year where this girl, had some major claims. So at renewal, they gave them an option to say, if you're willing to not go out to bid to anybody else, we'll renew your group at 4%. So they, of course, jumped on that and said, that's great. And we were introduced to them right before they were ready to renew. And I said, okay, why wouldn't you go out and at least try to see if, in fact, you might get some other carrier or carriers that might be willing to take a risk? Because remember, the carrier you're with, they were the ones who took it on the chin and had to pay all that in claims on this one individual. But being that was 2 years prior, and that individual is now very much controlled, nowhere near even close to that kind of claim. So we suggested, if you give us their census, give us the one and only plan design. There were two parts of that. One, that they only had one plan for the whole group, which the hair goes up on my neck. But the second thing was it was contributory. So everybody was contributing to the plan, but they only had the one plan. So I said to the gal who basically was running the whole HR and CFO all in one, if you get me the census, I can at least try and see what I can come back with. To make a long story short, there were two carriers that came in. One was 150,000 below what the renewal was. The other was 130,000 below. And she couldn't believe it. And I said, well, understand that they weren't the ones who had to pay the $1 million in claims. That was your existing carrier. A new carrier looks at this risk a lot differently than the one that just took it on the chin. So it was worth it for them to do this. So they then asked, is there any way we can get the plan to be a little better than what it was? Because they only had the one plan. So what I did was give them two benefits that I felt were important for a lot of groups. One being, and it's interesting because the CEO said that his son had been in the emergency room twice the year before, and their plan, the emergency room, applied to the deductible. So I said, I'll see if I can get a copay for that so you won't have a deductible, which happened in one phone call. The second thing that a lot of groups like is what we call high-cost diagnostic, MRIs, CAT scans, PET scans, typically very expensive scans, again, all applying to their deductible, which was $3,500 in this group. So I got them to do that for just a $75 copay, no deductible. So those are two major enhancements to the plan and still save them $150,000. They were ecstatic, but that wasn't good enough. So she came back to me and said, do we have to just offer one plan? And I said, actually, I've been waiting to ask you, why are you only offering one plan? So we decided we wanted to do the threesome, doing the low, the medium, and the high, being that their low option was the silver plan, which was not bad because now we made it much better. We wanted to have that plan, but we also wanted to offer them an HSA option with a higher deductible for all the people that are very healthy and more concerned about just knowing their exposure is to a maximum and take advantage of a tax benefit. And then we also wanted to have a very rich plan, a gold plan that people can buy up to if they chose they wanted to get something even better. So in essence, by offering all three plans, it just made it that much better of an offering for all of them, yet with the company's exposure being at that silver level, which ended up saving them a ton of money. So again, I say if it's a win-win where the employee gets a better plan and it costs significantly less and the employer saves a bundle of money, then everybody's better off. And that really was the goal, is to give them something that works out well. Now, interestingly, at the end of that first year, their claims were, in fact, reasonably good. They came in, it was just shy of a 10% increase. I showed that to them. They came back to me. And what ended up happening is I went back to the carrier and said, do you think you can get that down a little bit? If we don't go to market, we'll leave it with you, because they were very happy with this carrier. They didn't want the other carrier that was actually saving them a lot also. So we went back and basically they came down to 5.2%. And of course, this woman who's a master negotiator said it would look a lot better if you could get it under 5. So I made one phone call. I was on the phone with her and said, do you guys think you can get this under? They came in at 4.99. They were thrilled. So the group stayed, they renewed, and in essence, for 2 straight years now, have saved quite a bit of money because they're in a better plan, or in this case, they have more plans that give them more flexibility with their employees, because they were not all in the same scenario as this one dad of a son who had a major illness. But, it ended up where it worked out very well for the group and for the individuals with that.
So on that note, now we're in the mid-market. There's so much more flexibility in terms of what we call large group negotiation. We'll delve into that a little bit more in terms of the actual process, how you approach, the broker approaches the carrier or carriers and systematically negotiates and is an advocate. That's how it works. I am advocating for my client, and I'm going to get the best possible deal. So, but there's one other mid-sized company that I think had very important outcome, with this company. Alan, if you could explain what happened with this one strategy here.
Okay, so this is a group with about 85 people, again, in what we call the mid to large market because it's over the 50 people. They went with a plan with one carrier, interestingly, same carrier as another one. Initially, when we came in, we saved them quite a bit of money just by switching to this plan, the plan that they were in, because it's a local company here in Fairfield County, actually, but they had a plan that was not a PPO plan, which I'm a big believer in and out of network coverage, no matter what, because I just feel it gives everybody more flexibility just in case they always needed to go to the best of the best that may not take anything but Master, Visa, or American Express. So it's always important to have an out. They were actually in an HMO, just in network coverage. So by moving them into what we call a PPO, or in some cases a point of service plan, it made more sense for them anyway. So not only did we reduce costs, but in that first year, they had one woman who had her first child and ended up being a preemie, came out about 2 months and a week early, and what we like to call in our industry the good old $1 million child. In pediatric ICU for almost 2 months, was extremely expensive, obviously. Thankfully, though, the child is fine, the mom is fine. Unfortunately, the group took quite the increase for that first year because that was something that happened that nobody really expected, but it happened. But it's over and done. Differently than heart disease and cancer that sometimes is more chronic. This was just a person who had a baby, had a difficult experience. Thankfully, everything's great now. But in this case, it was extremely costly. So the in-force carrier, I did say, if I have to, I'll go to somebody else because I know you had a rough year. They still were able to reduce their initial increase by almost 11% because I was able to go out with other carriers and get rates that were significantly below them. Even though they liked the carrier they were with, I was able to use the other carrier's numbers to help negotiate with the in-force carrier to get the renewal to come down, which they did because they wanted to still retain the group. They had one bad claim. You know, there were other claims, but nothing like this one. They realized also that this was kind of a one-off situation. It happened. It's not going to happen every single year. And in fact, for 2 straight years now, they've had minimal single-digit increases because the group is run pretty favorably. But that's what happens. Part of what we do is we will get other carriers if we need to involve to use them to help negotiate our client's renewal with the existing one. We kind of have them beat themselves up, and that's part of the game, as we like to call it. But that's what we do, is we want to make sure that our client ends up with the best situation. So in this particular case, we were able to get that for them without having to change the carriers. We did change the plan design just last year. And in fact, we haven't seen the renewal yet. Actually, I haven't taken it back. That renewed in September. They came in with the lowest increase they've ever had, which was 5%. And yet they came back to me and said, if you're willing to not go to market and quote it, we'll leave it as flat, meaning no increase at all. And I said, well, I could call them, but I already know that answer. So I did call them, and they said, 0 increase? You're kidding. I said, no, that's what they're willing to do. And they said, done. Sign the papers. So now they got, a rate that's very much affordable because it's right back where it was. So they're a happy client.
Yeah. So you all have brokers, and these are some tools that you could talk to your broker about incorporating. It takes a little bit of effort to do these negotiations, and we're going to focus on one large company with 300 employees, and we'll focus. We've been helping this client for many, many years, but this is the essence of large group negotiation. It's not just, oh, can you do better? And then, okay, thank you. It's much more involved, has to do with asking and then working with people in the company that have the authority to actually make fundamental changes, change plans, change costs. So Alan, let's talk about this company. It's 300 employees. They're all over the state of Connecticut. Talk about the negotiation process. So just explain how that works.
It's a wonderful group. I mean, the woman who basically runs the company, who interestingly is the only one without the same last name as the owners, but she's been with them for close to 35 years. And actually, she is the one that Gary had talked to. We started this conversation when we introduced them to what an HSA was. And she was very interested in finding out. We went through all that, but they have always offered a minimum of 3, in most years 4 different plans, because they have a lot of variety. They have some people that are extremely healthy. They have some that are not. And there's a lot in the middle of that. So we wanted to make sure that they had 4 distinct price points where they can decide based on that and their health, which plan design made the most sense. So this is a group also that every year, with whoever the carrier has been, and over the course of 16 years now that we've had them, they've been with 3 different carriers. But in every case, the reason they changed was because of cost. They had a bad year. They got, in some cases, I want to say ultimately like an 18% or more increase. And they just, she's a master negotiator, the one who makes all their decisions. So my strategy with them every single year is whatever the renewal is, I get it from the carrier, and they will tell me, well, we could do this, we could do that, we could do that. I said, I need you to send me the renewal as is for starters, which they do. I then will send that to this gal and say, here's a renewal on all 4 plans, of which they're not all always the same increase. They might be certain plans that are, depending on who those people are that are in them, get lower increases than the other plans that are majorly utilized. So they give you an average increase. So when we say 18%, it may have been 6, 10, 20, and 26. So in average, it was 18, but when it's all said and done, the ones that a lot of their people were in might have been the ones that are the better plans. So what we tried to do is show them the renewal before we do anything. And then I will go to her and say, okay, here are these plans. What tweaks can we make that might be able to reduce these costs in different types of plans to get it down to a number that you can be comfortable with, knowing that you just had a horrible year. Your claims were not good. I mean, so far in all those years, I think we've had 2 where they've actually been really good. They're not really what I'd call a great level funded candidate. However, they were in a level funded plan for several years because of, the last several years, yet they've never received the refund. But because they were in that, they were able to also get a slightly better rate because the carrier always thought that they would be a great candidate to get refunds because their premium was north of $1.5 million. And they just figured, well, these guys can't spend that much. Little did they know they did a few years, but they have had a couple years that have been okay. So what normally happens, we come back with a number, whatever the number is, I will go back to them and say, all right, they're not going to accept that. I need to be able to get it down to X, like 10 at least. So they'll give me different options. And one of them will always be, are you willing to not go to market and quote? I said, well, I'm not sure because I don't know how much lower you can get. So what we try and do is find out the best they can do with exactly the same plan that they have. And then we might change a copay by $5 on a doctor visit or on a prescription or on an x-ray or a hospital deductible changed by $500 for the year. Just little tweaks that might end up shaving points off the renewal and making it a little bit more attractive and yet still keeping the plans intact. So that's what we do. And by the time I then am able to go back to this woman, I'm usually able to get it down to a far more reasonable enough level. And in many cases, she'll say, well, I need it to go even lower. So I then have to go back to my service rep and also the underwriter who handles that case and say, all right, what do we need to do to get to this amount, 8%? That's what she can live with. And they'll give me options of what we can do. And in many cases, without drastically changing the plans, we'll get it to there because they don't want to lose the $1.5 million in premium that they're getting as long as they're making a profit. If they're paying $1.5 million and they're paying out $2.5 million in claims, they don't want them, but they're not that bad. But the point being, they have to make a decision, carrier. How willing are they to work with this investment for this group? And in many cases, they'll do some amazing things to get the rates to where they need to be to retain the group. And this group now has been with this one carrier for the last 4 years, and their average increase has never hit double digits, which is amazing because they have had a couple of years that were not great. But with some plan design changes, we were able to get them down below. Best year we got them was a 1% increase. They were ecstatic about that. And they'll never stop asking for more because that, couldn't it be like less? Like, give me a break. You got 1%. That's pretty good. But bottom line is we listen to what the group wants. If they're satisfied with what we get, then everybody's good. We're happy. If on the other hand, they need us to do more, or we need to go to another carrier to try and get somebody to take on this kind of a risk, we'll do that. And we have the whole market because we can go to anybody. And then it's just a matter of giving them really what they want at hopefully a rate that's going to be good for everyone.
So what we're thinking here is some of these strategies are pretty much common sense. Medicare offsets, base plan approach, expand the plans from 1 to 2 or 3. They oftentimes are overlooked, and just be mindful of those. Then the more sophisticated options have to do with approaching the level funded type plan that is unique in their strategy and in their structure. And then, of course, the large group negotiations come down to becoming very familiar with our clients, understanding them, working with them, and working with the carrier. The carrier wants to keep the client unless they're unprofitable, then they're glad to let them go, and they're just as happy to bring them someplace else. So these techniques are utilized in Connecticut, and many companies in Connecticut have employees throughout the country. We have clients all over the country, so we have to be mindful of having the type of capacity where if there's employees in Florida or if they're in Ohio or they're in California, we work within the structure of those particular states and make it appealing if the company's headquartered here in Connecticut or they can be headquartered elsewhere. Now that leads me to a final topic that I wanted to bring up. And this particular group the company is called a PEO. And a PEO specializes in a few things. And this particular PEO is very active in one of your Midwest regions. And the reason why they're brought in is to mitigate HR nightmares. They can do employee benefits, they can do the health plans, they can do the workers' comp, they can carve them out. But their primary benefit, if you know of companies or if your company is having HR nightmares, they can come in and give some very interesting, solid risk management and HR solutions that are very appealing and very attractive. So if any of these topics, especially this PEO, resonates, just let us know. And I'd be happy to tell you who they are and you can call them.
PEO, by the way, is Professional Employer Organization.
Right.
There are many, many of them out there. The one Gary is referring to is probably one, if not the best one out there. But they are all initially payroll companies. That's how they start. They all have their payroll because a lot of payroll companies are doing a lot of these employers' payrolls, and they do the direct deposits and they do the contributions and they pull all the monies out of their checks. It was an easy transition for them to make to transition into the medical field, which is what they did probably more than 10, 15 years ago, actually. They've become far more prominent, more than likely in the last 5 years, all size companies. I mean, they could go down to a company as small as 5, and they are in companies with thousands. And sometimes, as Gary said, they'll do everything. They'll do the medical because sometimes they come in very low on that. Because what it is they're made up of multiple employer groups like yours, meaning it could have 500 companies all in there. They are one PEO that handles all of them, but you get rates. You're now on a kind of a discounted slate because you're now in with many, many, many other companies, which just makes it more attractive. They give you numerous plan designs to choose from, lots of flexibility. But like Gary said, if you're better off where you do your own medical, because you can get a better deal like that in dental and vision and hearing and long and short-term disability and life, they can do all of those things, or you could do them yourselves, and they could just end up doing, for instance, your payroll and all of your HR work, which they're really good because they've got an entire company that's your support staff. It's like a library of people that basically handles everything. And a lot of companies we deal with, you're dealing with the owner, a controller, a CFO. We're lucky in many cases they have an HR director, but in many cases they don't have that. In which case a controller is now doing a job they really don't want to do. They want to help their company make money and cut costs and do what they're supposed to do. This is one of those things, but if they don't have to then worry about this and the PEO handles all of that, it's just a nice avenue to have. And they are becoming very popular. They're not for everybody, but they are a valuable piece in the holster when you're looking to see what might make the most sense from these groups. Now, they're not always the most competitive. Interestingly, this group, the first one we talked about that was a nonprofit, they were in a PEO. Unfortunately, their claims and their age of the group average was significantly higher. So their rates were not that good. And then their claims were not good at all. So they ended up where it wasn't really a good fit, but we were able to find them a great solution. So it's good for some, it's not good for others. But that's kind of the way our market is. There's not one, I'll go back and say that again, there's not that one square peg that fits into the round hole. You've got to find the right mix based on the needs of a company. And that's what we try and do, is find the right solutions. That's what you guys should be doing.
So we hope that our attendees want to thank you all for attending and for spending time hearing what we have to say pertaining to the strategies and the methods that we've incorporated. And we feel that you may benefit from incorporating some of these ideas in your own renewal process. So if anyone has any questions, please ask now or contact us at a later time. We'd be happy to address your particular parameters and specifics.